Welcome to our eSignal Weekly Forex and Futures Forecast. My name is Jay Norris. I teach trading at Trading University. First market we're going to take a look at will be the Australian US dollar. Here's the Australian US dollar. You can see there's our RTT ratio, risk tolerance threshold ratio right there. Everything's down, right? On the other hand, you're at pretty long-term support. I should probably define that. That's about 10-year support. That's a big level. So all your shorter term from your secondary on down to your day trading patterns are lower. On the other hand, you're sitting right on top of pretty stout support. And the reason I could say that, it held the first time down, right? It would really take a couple of monthly closes below that level to spell further downside for the Aussie. So from our perspective, you've got pretty good support down below. We've been saying, for the last month or so, that we see Aussie very close price-wise to a bottom, but perhaps it'll take some time to carve out a bottom, and it's probably going to take some stabilization in the Chinese economy and the Chinese stock market as well, and we're starting to see that also. So long term, from peel out to historic perspective, we think Aussie's potentially a pretty good buy in here, and we like that level long term. We think it'd be worthwhile to start taking a look at your portfolio, make some room for some long Aussie, some long FXA, the Aussie ETF. You can buy it like a stock. So that definitely something to consider going forward. Next market we'll take a look at will be the Swiss franc. A little bit shorter term, we like the Swiss franc on the upside, and you can see it's kind of struggling, a little more relevant right now. We like the Swiss franc right now. It looks like you're in the midst of a breakout here. Look at all those shorter term patterns, really from the 50-day on down are bullish. That's been a market that's been rewarding dip buyers. So definitely like the Swiss franc on a short and intermediate term basis. Certainly from a longer term perspective also. And if you're wondering, hey, how can you like the Aussie long term and the dollar Swiss long term? Well, remember the Aussie's not in the dollar index itself, right? Wow, look at that. Look at that market. So we think there's plenty of room on the upside in the dollar Swiss. If anything, from a percentage wise, there's probably more room. So we definitely like dollar Swiss too, from a longer term perspective. Dollar index, we like it. If we like dollar Swiss long term, we like the dollar too. Maybe not as much. I'm a little bit concerned here that you're seeing not the most robust numbers here into the third quarter, and you can always count on decent numbers into that fourth quarter because you have the holidays coming up. But we'd certainly like to see bigger numbers. I'm sure the Fed is thinking the same thing. I'm sure the Fed would have much rather been in a position where they already raised rates based on that accelerated economy in the second quarter, which they got. But the first quarter was so anemic, you almost had negative growth in that first quarter. So a little bit concerned with the slowdown in the U.S. economy. I know you had a gangbuster GDP number, but that's a rear view mirror number. Like to see retail sales, like to see durable goods doing better. Durable goods had zero growth last month. So, that's a concern. But I think long term, the die is cast. The Fed will be raising rates at some time this year. And, not sure how that'll play out as far as the stock market and the bond market. But it's going to be dollar bullish for the currency. And that's why we keep saying long term, you got to be long the dollar long term. You see these short term sell-offs, and at the bottom of those, that's when I'll beat the drum the loudest about you got to be long, because those are the opportunities to get long. I was speaking of the numbers for all the negative data in the last month. Well, I should say the lack of positive data in the last month. Look at that, the dollar keeps coming back. I mean, if you go back 25 days or so, draw a 25-day box, you're still at the high of that box. So we like the dollar. You got to keep beating the drum for long dollar positions. The breakout perhaps may not be as big as it would have been if you had a continuation of that growth you saw in the second quarter. But nonetheless, you don't want to be shorted, and that's my point. So we like the dollar long term here. You can see you've been in a sideways range for much of the year. Next market, the euro. Euro's had a lot of back and forth, and there's definitely ways to take advantage of that. The euro's been back and forth through much of the year. You can see you have a bit of a shakedown here, a bit of a breakdown, but at the same time you're sitting right on top of support. So you look back the last 6-8 months and it's been nothing but sideways. Right now though, this pattern's telling us that we have to remain short on the short term. A little bit cautious coming up on 50-day support right there. It held that's that same support level that held earlier in the month. It's still holding up, and then you got major secondary support right here around 108. So these are levels to watch. I tell you what though, from a trader's perspective, just because the market's going sideways, that doesn't mean that you can't make hay. Here's our short-term benchmark trading performance for Trading You, and we've got that updated into September. Boy, look at that performance, and that performance is based on these lower time frames, the 50 through the 5, right? So you're always going to have something to do when you're focusing on those lower time frames. And from an analyst perspective too, you're going to be able to accumulate a larger sample size of trades too when you trade on the lower time frames. We're big believers that markets are fractal in nature, and we really believe this chart proves it. We think longer term, if you had a similar sample size on those higher time frames, that you'd see a similar performance. However, to get that larger sample size, you got to scroll down to those lower time frames. So that performance is pretty much based on, for the most part, the 5 through 25, but then we'll trade the 10 through 50 patterns also. There's more than one way to carve up a cow, and trading different time frames we feel is the way to do that. Gold market. Gold's coming to life, and again, it comes back to those somewhat disappointing economic numbers in the U.S. Over the last month, and that's given hope to gold bulls. You held long-term support in August, and we talked about that at the time. I said that could potentially be, a longer-term secondary bottom building, and that looks like that may be the case, because look at that. The 5, 10, and 25 are all up now. Arguably, you could say that 50 days up. I'd really want to see it get above that orange box right there before we can say the 50-day. But technically, time has shifted to 50 days. Because if you go back more than 50 days here, if you go back 50, 60 days, you're going to see you're in the upper 2/3 of that range. So, a market that's in the upper 2/3 of a range like that, you can't say it's bearish, right? So it can only be one or the other. So from our perspective, gold warming up on the long side, even on that 50-day. I'd rather see price take it out rather than time shift the market though. Long term, however, you still got the monkey on the back here. You got the secondary down and the primary pattern, that all important primary pattern, all down. And you still have a sword hanging over that market when the Fed does come in and raise rates too. Thank you so much. My name is Jay Norris. I teach trading at Trading University, and we'll see you all next week.